For decades, Americans believed one thing about housing, that prices always go up. But right now, something unusual is happening across the United States. Home listings are quietly rising, insurance costs are exploding, migration patterns are shifting, and in some states, economic pressure is starting to crack the housing market. Not everywhere, but in certain places, warning signs are appearing all at once. Falling home demand, shrinking job markets, rising property taxes, and more homeowners trying to sell at the same time. Historically, when these signals appear together, they often come before local economies begin to weaken. To understand why certain states are vulnerable, we need to look at what changed in the last few years. During the pandemic housing boom between 2020 and 2022, home prices surged across the United States. Cheap mortgages fueled the buying frenzy. Remote work changed where people wanted to live, and millions of Americans moved to new states. But by 2024 and 2025, the environment began shifting. Mortgage rates suddenly jumped, construction costs also surged, and household debt quietly reached record levels. At the same time, migration patterns shifted again. Some expensive states began losing residents, while other regions suddenly expanded too fast. New homes appeared everywhere, but buyers began slowing down. Historically, this combination creates risk: housing supply rising, population movement shifting, and job markets becoming unstable. First on the list is Florida. Florida experienced one of the largest housing booms in the country. Cities like Miami and Tampa saw explosive price growth, but now the market faces a new problem. Home insurance costs are rising rapidly. For many homeowners, the costs are becoming difficult to sustain. Shift to another major growth state. Texas attracted millions of new residents during the migration wave. Austin became one of the fastest-growing housing markets. But now, housing inventory is rising quickly. When supply rises faster than demand, prices usually fall. California faces a different problem. More residents are leaving the state than arriving. High housing costs are driving people away. New York faces similar challenges.
Population growth has slowed dramatically, and housing costs remain among the highest in the nation. Illinois has struggled with economic stagnation. The state has been losing population for years. Nevada's housing market is known for extreme cycles. During the last housing crash, Nevada was hit especially hard. Arizona is another fast-growing market. Rapid expansion often creates hidden risks. Colorado also experienced major population growth, but housing prices rose faster than wages. Louisiana faces long-term economic pressure. Natural disasters continue to affect housing costs. West Virginia faces decades of population decline. Limited industries make the economy fragile. Alaska depends heavily on energy markets. Economic swings there can happen quickly. Mississippi remains one of the lowest income states. Lower incomes limit housing demand. Finally, Michigan faces manufacturing risks. If a recession hits industry, the housing market often follows. When economists study recession risk, they rarely focus on just one indicator. Instead, they watch for patterns. And right now, several patterns are emerging. Housing inventory is rising. Insurance costs are increasing in several regions. Migration patterns are shifting again. And interest rates remain far higher than during the housing boom. On their own, none of these signals guarantee a collapse, but together they create pressure, and housing markets are often where economic stress appears first. Homes begin taking longer to sell, prices stop rising, then eventually they begin to fall. When homeowners struggle with rising costs, the pressure spreads into the wider economy. Construction activity slows, retail spending weakens, and job growth begins to slow. Looking toward 2026, economists are watching several triggers. A rise in unemployment could weaken housing demand quickly. Migration could shift again, and some states may suddenly face more homes than buyers. Housing downturns rarely happen overnight. They usually begin quietly. Listings slowly increase, prices flatten, then the broader economy begins to feel the pressure. The biggest economic changes rarely start with headlines. They start with subtle signals that are easy to miss.